Welcome to Control Plus Q, where we discuss economics, finance, and investment from the perspective of high school students. Hi, everyone. In this episode, I talked with Isaac about risk tolerance in investing and how it impacts financial decisions. So kind of just like talking about in long-term investing, like what is risk tolerance and like how does it kind of affect your investment decisions, and how should people look at risk tolerance and how should they approaching risk?
Yeah, that's always an interesting conversation because a lot of people, people I've talked to in the past that are clients and then are not clients as well, they'll say they want X, Y, and Z as far as like a rate of return. But then when I start asking them some more questions about like, what tell me a little bit more of the downside, essentially like how much does the market or how much does your portfolio have to go down until it starts making you very uncomfortable? So what ends up happening is like we want as much, I mean, this is just in our human nature. We want as much as we can
Hmm.
without risking anything,
Right.
It just doesn't, it doesn't really happen that way. Um, if we look on a long-term data perspective though, here's the way to look at it is let's kind of look at it maybe from a very easy point of view. The faster we go, like in a car, right? The
Hmm.
faster we go, the if we turn that steering wheel just a little bit, the more wild, the more volatile the car will be. Okay. So if we're turning that steering wheel and we're only going like 10 miles an hour, we're not going to really feel any volatility. That's like basically saying, hey, we're only going for like a 4% growth per year,
Hmm.
which means you're barely going to feel any kind of volatility. But if you're trying to go for like 10 to 15% growth per year, which is a little bit more challenging because it's above the S&P generally, depending on the time frame you're looking at.
Hmm.
Uh, that's like going 70 miles an hour down the road, and you just gotta, if you jerk that wheel, you're definitely gonna put yourself in some risk. So
Right.
uh, that's from kind of like a very high view. But as far as a numbers perspective, if we think of it like this, if we want growth,
Hmm.
growth is generally 8 to 10%. Then you should plan on experiencing about a 20% volatility shift. Okay, well, what does that mean? Well, you can basically, if you're trying to go for 10%,
Hmm.
don't be surprised if your portfolio goes up 20% or down 20%, because that
Right.
is like the what we call is your kind of average, right? I mean, it's a standard deviation, which technically is the 68% average of the movement of your securities. Okay.
Right.
So the higher return that you seek, the more of that volatility swing you can expect. Okay.
I see.
So yeah, so those are some kind of soft numbers. It depends on what you're looking at, of course. So do your own research, or of course, like your audience who's listening to this, do your research on how to compute that. But essentially, if we're thinking about like the S&P, like at
Right.
10%, we can expect anywhere between 20 to 22% fluctuation plus or minus in a given year.
I see.
Yeah.
And so like personally, do you have your own expected growth when you're doing your own investing? Is there like for your own personal investment portfolio?
My own personal, yeah, that's a great question. I don't think I've ever had anybody ask me that question before. Personally, like my own personal assets, I mean, yeah, I like to go for 15 to 20%. Uh, I have, there are things I can do that I feel from my knowledge basis, I can limit my downside because I know how to short, I can write
Mhm.
covered calls. I can buy, excuse me, I'm not sure if you could hear that. I could buy covered calls. Excuse me, I'm sorry. I could sell covered calls. I could buy puts. There's just different methods I can do in my own personal investing. We run a fund as well. We run a small hedge fund. We can do, we can short, we can take different exotic positions within the derivative space. So, this year I know we're doing pretty well, but it's because we've used risk management to try to limit the downside. We had that move in August that the market went down like I think 13% in literally like 4 days. Well, we were actually up because we had some long exposure to the derivative market. So we didn't know if that was going to occur, but we had them on as risk management products. Essentially, we were there in case something like that would happen, because we've had this happen before. Every year and a half, there tends to be a pretty steep drawdown in a very short period of time, and it usually happens over a weekend. Thursday, it gets bad. Friday gets worse. Monday, you puke, and then that's the time to buy. So, but we haven't had one of them in like a year and a half. So we kept putting them on, these derivative products. We put them on, with really limiting our outlay. We didn't have to spend a whole lot of money. And when that event occurred, it was like, wow, okay, that was worth, the insurance that we paid on it over the past, 9 months. So it definitely helped buffer out the volatility. So anyway, to answer your question, for my personal, yeah, I try to shoot for, this is just personally, 20-ish% usually would be a good number for me. But you know, I can't force the market to do what I want it to do. I just have to manage the money in a way that is really, really correlated to the market that we're in. So
Right. And then also just speaking on what you just said about the market downturn you said, or like the little
yeah,
period of time. Do you know why that happens? Why this happens so regularly as well? Every like year and a half, you said?
like a very steep drawdown.
Yeah, very steep. Yeah, what you were talking about before.
Uh, why does it happen? I mean, nobody knows why it happens. It just happens, and because I've been in this space for so long, you start noticing, especially like the first time I didn't have any protection on, which was this was over 10 years ago. I was trading my own personal account, and then we had that drawdown, and it was very memorable. In fact, it was probably one of the worst drawdowns. I think, what was it, 2014, or was it 13? It's like 2014, or maybe it was early 2015. There was a weekend event that was horrific.
Hmm.
What happened was, I think it was again a Thursday, Friday, and then on Monday we limit down. So it's a little bit of a technical term, but you saw the S&P futures, and I think maybe the Nasdaq futures, they opened up, or they hit a circuit breaker in the pre-market, and then opened down, limit down, which means the market opened down 10% from Friday.
Oh.
Yeah, exactly. It was like that bad. So, but even in the pre-market, so in the pre-market before the market opens, there's actually trading that occurs within the futures markets. And what happens is, if any futures product hits a 10%, or actually, I think that the circuit breaker is 7%, I believe, but if it's down 7% in the pre-market, what happens is the market stops. Like the futures markets, or from that product, stop trading.
Hmm.
It like halts, and then it halts for I think 15 minutes or so. And then when 15 minutes is up, it reopens, and then let's see what happens, and see if like the market begins to stabilize. Well, I think what happened was, when it did it and opened up, I think it halted twice. So it's definitely and I'm trying to remember, this was like obviously over 10 years ago. So it was that dramatic of a move that you just remember. And then in the corresponding years, you start noticing, oh, there's another weekend event, and then another one occurs, and then another. And then, so at this point, though, it had been well over a year. It's actually been like 2 years. I'm thinking we haven't had this like weekend drawdown. So we were putting on protection because the market just kept going straight up.
Hmm.
Usually there's going to be kind of a reversion, like a kind of a rebalance, a respring back, to kind of level off the prices. And so we got it. It just took a lot longer typically happens. So,
Mm.
but you just, you watch the markets long enough, you pick up on these kind of very interesting patterns over the years.
I see. Oh yeah, that's actually really interesting. Just like yeah, having the experience and the knowledge. It's just knowing when things happen and when things kind of being able to predict things like that. So
Yeah,
yeah.
hard to predict, but essentially, that's what they say is somewhat true is history tends to rhyme, or was it what's the saying? History doesn't repeat, but it tends to rhyme, something like that. So, like there's, you know, these moves historically happen in different fashions. It could be
Uh,
worse, it could be not as worse. So, but they
so
generally
yeah,
do happen
yeah, it happens, but like in a different.
different way. Yeah.
That is all for this episode. Thank you for listening, and I will see you next time.